The recent analysis titled "The Next AI Winner" isn't big tech. Its energy argues that while most investors and commentators focus on the large technology companies and chip makers driving artificial intelligence, a much less obvious but potentially far more powerful investment theme is emerging in the energy sector, because the vast data center and AI infrastructure build-out is exposing serious and underappreciated bottlenecks in power generation. Natural gas supply, transmission, infrastructure, and export capacity. According to the author, the energy sector is poised to benefit from the AI revolution in ways few expect. AI depends on compute and storage, but compute and storage run only when the lights are on. So as demand for AI accelerates, the real constraint is increasingly becoming the infrastructure that supplies and delivers power, and the fuel to generate it. The article points out that energy companies, especially those in low-cost natural gas production, LNG, liquefied natural gas export capacity, pipeline infrastructure, and power generation facilities are sitting in a sweet spot because they may see demand surge, not just from conventional uses, but as a foundational element of AI-driven growth and global digital infrastructure expansion. For example, the piece highlights companies such as Antero Resources and EQT Corporation as being particularly well-positioned to benefit from higher natural gas demand tied to AI and LNG export tailwinds. The author also argues that from a valuation and risk-reward perspective, energy stocks may offer better upside now than many of the high-flying technology stocks, because the tech names already carry high expectations and premium valuations, whereas many energy stocks today are underestimated and face structural upside if the power story plays out in quantitative terms. The article forecasts that the ratio of the energy sector ETF, for example XLE, to the broader market ETFs such as SPY, could rise significantly, reflecting a rotation of capital from the headline tech winners into the energy infrastructure theme. The piece further emphasizes that this isn't just a cyclical bounce in oil and gas prices, but a structural shift. AI infrastructure is global, power-hungry, and requires production, generation, and transmission capacity, which were built for yesterday's demands, not tomorrow's AI-driven compute loads. That said, the article is careful to emphasize the risks. Energy remains a cyclical business, subject to commodity price swings, regulatory risk, environmental and permitting risk, and the potential that AI growth may slow or become less power-intensive. If efficiency improvements or alternative architectures reduce consumption, the author even leads with a caution. This group of stocks is one of the most volatile in the market, so only investors comfortable with that kind of risk should seriously consider the thesis. Nonetheless, the central message is that AI is not just about the software, the algorithms, and the chips. It's increasingly about the fuel, the power pipes, and the generation plants behind them. In other words, the lights-on story of AI, for investors looking beyond the obvious names and seeking alpha. The article suggests energy is the sleeper beneficiary of AI. The narrative closes by suggesting that monitoring the build-out of data centers, LNG exports, power grid upgrades, and natural gas capacity is a way to identify where that hidden upside could come from, and that if the thesis proves accurate, the real winners will not necessarily be the giant tech platforms we all know, but the companies supplying the energy to power the AI engines of tomorrow.